Hello and welcome to the February 3rd, 2023 edition of Watching the Tape. With yields on U.S. Treasury securities being fairly attractive these days, I wanted to answer a question that we've been fielding recently. But let me tee it up first. Our clients have portfolios that have long time horizons and are invested in an appropriate mix of stocks and bonds based upon their individual investment profiles. Well, many of these clients also have a separate slug of money that they want to keep readily accessible. So the money might be earmarked for a project or an investment in the next couple of years, or they just want to be opportunistic in case something comes up, or it's just a big emergency fund. Now, there are cases in which we will ladder short-term bonds for conservative clients' long-term investment portfolios, but that's not very common. All right. Yields on treasuries have become relatively attractive in the last year or so. So what we're looking at here is the one-year treasury yield, 12-month treasury bill, looking back 5 years, and we can see that there were some dark times. It was basically at zero up until a little more than a year ago, at which time rates started to climb. And we find ourselves at 4.6% today, so not too shabby. So getting back to that question, what if I buy a short-term treasury, but then end up needing that cash before it matures? So we're going to walk through some examples to illustrate how that looks. So in this hypothetical, we will be buying a 12-month treasury bill. So along the left, you have the price, and along the bottom is just the timeline. So we're going to buy it at 96, and our plan initially out of the gate is to wait for it to mature a year from now and then collect par, or 100. So let me make a distinction. Treasury bills are short-term, so they're issued with a year or less to maturity. They don't have periodic interest payments, so you buy them at a discount and they rise to par or 100, and that's when you get your money back. So in this case, buying at 96, getting par at maturity, that's a 4.2% yield. So I'm using round numbers here. I know that the prevailing rate is 4.6%, but for our purposes, we're going to use this 4.2% yield. Now, month 6 comes around and you need the cash. How does that look? So in this first scenario, let's say the market yield for a 6-month treasury bill 6 months from today is 4.2%. So it's the same. In that case, you could sell it at 98 cents on the dollar. So you could sell it at 98. And that would be a holding period annualized return of 4.2%. So that's what you're expecting. Nothing changed. You got your return annualized of 4.2%. All right, let's move on to an example here in which the market yield goes up. So interest rates go up. And so that straight line is not going to be straight for much longer here. I mean, this is what you thought was going to happen when you bought it, 4.2% yield. Month 6 comes around, you need the cash, and the market yield has gone up 150 basis points, or 1.5%. So again, this is the yield on a 6-month treasury 6 months from today. So think about it this way: if you're the buyer of this, so you have it, you're selling it to someone. That buyer, in order to get a yield of 5.7%, is only going to pay you 97.25. All right, these are round numbers. The decimals are a little bit different, but for our purposes, I think we can make the illustration without getting down to the exact number here, just in case anybody's checking my math. All right, so that's a holding period annualized return of 2.6%. It's not negative, but not what you were expecting when you bought the treasury in the first place. Let's go to an example, which you buy that same treasury at 96, and in this case, rates go in your favor. So the market yield 6 months from today on a 6-month T-bill is 2.7%. So the buyer of that's willing to pay more because, in fact, they're willing to pay 98 3/4 because that'll get them the prevailing interest rate at the time of 2.7% for the remainder of the term of that Treasury bill. All right, the holding period annualized return to you is 5.7%. All right, looks good. So we're going to use pretty much most of the same numbers here, but illustrate this in a slightly different format to really drive everything home here. All right, in this case, it's a pretty unwieldy slide title there, but we're selling 100 12-month Treasury bills 6 months later. All right. So let's walk down that first column there, rates unchanged, kind of our base case. Purchase price at 96. So your total investment is $96,000 in this example. So remember, treasuries come in denominations of $1,000 each. So 100 at 96 is $96,000. The sale price, if you remember, is 98 cents or 98 in 6 months for sale proceeds of 98,000. So that's a holding period return in dollars of $2,000. And then again, that's 4.2% annualized. All right, so we'll use that as kind of our base case. So let's go to the rates up 150 basis points or up 1.5%. So the economics of the purchase are exactly the same. Your initial cash outlay is $96,000, but then you're selling this at 97 1/4 to get sale proceeds of 97,250, which is a holding period return in dollars of $1,250. That's, again, that was 2.6, 2.7% annualized return. Now here's the number that I want you to walk away with here. So relative to the base case of $2,000 over that 6-month period, instead, your return here in dollars is $1,250. So that's a delta of $750. So that gives you a sense of the magnitude of kind of what's at risk here. So let's go walk quickly through this last column, in which case rates are going down. They're moving in your favor if you're the holder of the fixed income security. You're able to sell that 6-month T-bill in 6 months at 98 3/4. Your proceeds are 98,750. Your return in dollars is 2,750. So again, 5.7% annualized. And that's a delta the other way. That's a swing, $750 to your benefit. Okay. So don't know what rates are going to do. We live in a world where rates are fluctuating all the time. Hopefully this series of illustrations gives you a sense of the magnitude of the price risk that you'd be exposing yourself to if you bought a short-term treasury and then had to sell it before maturity. I think it's manageable. It's pretty minimal. Before I let you go, we're talking about short-term treasuries here. We're not talking about anything beyond a year. So with bonds, if you were to buy, let's say, a 2-year treasury note or 5-year treasury note, you're going to be exposing yourself to a lot more price risk if you bought that and then 6 months later you have to sell it. So with bonds, the longer the maturity, the greater the price risk. That's it. We'll see you in 2 weeks.